Hi, I'm Siddhartha Dash, or Sid Dash, and I'm the Chief Researcher at Chartis Research. Today, we are going to discuss a little bit around the emerging area of digital asset risk, how to think about it, how to contextualize it, and what are the key issues around it, and how it's different from many of the risks that we have seen and similar to many of the risks we've seen before. For that, I have a guest who's helped define and has been a pioneer in many of the issues around this area, particularly around the data and the risk definitions. Nikos, could you introduce yourself?
Thanks for having me on. I'm Nikos Andrikogiannopoulos. I'm the founder and CEO of Metrika, one of the leading companies in risk management for digital assets. So I'm very happy to talk about digital asset risk and talk a little bit about the work that we've done together with Chartis in this domain, and why I think it's very relevant to where the market is today and where financial institutions are.
To start off with, I think the really critical issue is why now? I mean, digital assets have been around for some time. Markets have gone up, they've gone down, they've gone sideways. But why do you think today, large financial institutions, the mainstream institutions, need to really pay attention to this? Why do you think, why now, really, if you will?
Sid, this is an excellent question. Probably today we are 15 years from the time that Bitcoin came around. And I think it took several crypto winters and crypto summers for the technology to evolve, right? I think we had the first wave of blockchain, the second wave with Ethereum and EVM, and then we had the third wave of blockchain technology with much more mature and faster blockchain networks. But I think the missing piece so far was regulation. And this year in 2025, particularly in the US, that plays a critical role in the financial markets worldwide, we saw a very drastic acceleration of regulation that being in favor of digital assets. We saw that starting in January with the repeal of the SAB 121, which allowed financial institutions to do custody of digital assets. We saw that over the summer with the Genius Act that put some regulation together for stablecoins. We are seeing that now with the Clarity Act, which is going to be very helpful in the classification of tokens as either securities or commodities. And lastly, we're seeing a very big push towards tokenization of real world assets, towards equities being tokenized, and bonds and other financial instruments. So I think this has been a year where regulation has played a very critical role. And I think the rest of the world has been looking at the US for this acceleration so that they influence and they amplify the activity towards the rest of the world when it comes to digital asset adoption.
No, I think you're absolutely right. Regulations serve more than the dimension of telling you not to do something. They actually they actually define the playing field. I mean, what sport are you in? Is this soccer? Is this American football? I think it's defined by the set of regulations. Can you carry the ball? Can you only kick it once? And so on and so forth. So no, absolutely. But I think it's also very important at this stage to then think about a little bit about when you think about digital asset risk, think a little bit about the context in which it is come in, and the context and the history of other risks that the financial system and financial institutions have seen over time. And to that, I think going a little bit sideways and going a little bit backwards would, shine a little light on some of these issues. For example, commodity risk. If you think about commodity risk, it's not just the price risk. It's a lot about everything that surrounds those commodities. For example, in bulk commodities, it's the issue of logistics, pipelines, warehouses, and so on. And if you think about electricity, it's all about networks, physical power plants. And similarly, when we think about the way cyber is diffused through the financial system and non-financial risk environments, it brings to light many key characteristics of how do you compute and analyze and think about risk. I mean, cyber risk was possible because very large and detailed data sets of the state of the network, both inside and outside organizations, the IT network that is, became available and became increasingly possible to map states of those networks into their potential risk. And we've seen the cyber risk measures, cyber scores, cyber VARs increasingly diffuse through the system, whether they are insurance agencies or supply chain guys. People are increasingly using these measures, and increasingly what we see is key issues are they need to be tractable, they need to be explainable, they need to be you need to be they need to be attributable and so on. So I think this context is very important to keep in mind as we think about the emergent digital risk. So for that, I would like to ask you take a slightly different question, if you will. I mean, we've seen many new risk measures sort of, come up, if you will, things like climate, etc., modifying the market risk, modifying credit risk. But I would argue that in digital asset risk, the key fundamental issues, such as the technological governance and regulatory risk that are linked to that, are really foundational. They really define the asset, just as some of the things that we talked about on the commodity side. How do you take off from there? How do you sort of, what do you think about that, and how do you expand that?
I think, Sid, this is a very important topic. Like, if you think about the past, we were talking about cybersecurity risk because it was only information traveling over the internet. So a financial institution would have some systems exposed, like a mobile application, a web application, so that information would be exchanged with the customers. So the risk was that in having a hack and that information leaking out there, private information and so on. In this case now, it is value being transmitted. It is the asset itself in its digital representation being transmitted over the internet. So we are, and I think, to your point, I think the asset itself now is defined by the infrastructure over which it basically lives and exists. And to the extent that I think we're going to live in a world where we're not going to have digital twins after some point, there will be digital assets as standalone, right? It's not going to be the equivalent in the MP3 kind of, era, is that we're not going to have the disc where we read the MP3s. We're going to have music that is being produced in digital format exclusively. So in that kind of world, that digital structure and the digital asset will have an inherent risk. It's not going to be a risk modifier and an add-on on an existing asset that exists outside in the physical world, because there's not going to be one. And the beauty of that is that you could argue that these digital assets create efficiencies. They reduce costs. They can be collateralized, and the collateral speed can be much higher. And they can be, you can have them in DeFi protocols, in lending pools. You can earn more yield. You can transfer them anywhere in the world with minimal cost. But all of that efficiency comes at the inherent risk of the technology and of the infrastructure that is enabling that. So we have to look at the asset holistically, and we have to look at the inherent risk. And I know the work that we did together on the Chartis and Metrika white paper, we laid out the integrated composability risk on those assets. And this is how we need to view that. It's not like an environmental risk that is a modifier on some other existing risk that is happening. It is the nature of the digital assets in there.
No, absolutely. This is foundational, because the technology and the rules define the product, and the risk of that foundational environment is something that is that is absolutely central. So, in that light, could you define do you want to talk a little bit more about the whole idea of this integrated composability risk and other sort of related scores that we've been thinking about, if you will?
Yes, I think the importance of a score to a digital asset is that we need a very simple way for people in the risk business to easily whitelist or blacklist assets and say these are the assets that we feel comfortable onboarding on in our financial institutions, and other ones that we need to be more careful or even not off board. And instead of just thinking about key risk indicators and risk frameworks and thresholds and anomaly detection and talking about the ingredients that produce the risk assessment, we want to invert the process and say, here's a risk score, here's what this contains, and you can see a green, yellow, red kind of classification of where this asset lies in terms of that risk. And then you can decompose that into buckets and say, this is being driven by financial risk or non-financial risk. And what are the components of that financial and non-financial? And then if you wish, you can drill down to the key risk indicators and what is driving those risk scores. But I think the importance to the market of distilling things down to a single number has been, and I'm sure you've seen that in the past, has been historically important on every bucket of domain-specific risk. It was important in cybersecurity. It was important in ESG risk. All of the emerging risk categories benefit from the simplicity of a simple number. So I think the importance of what we laid out as the integrated composability score, and which we have implemented in the Metrika asset risk score, is really, really important. I think it's a groundbreaking thing for the industry, and it's consistent with the history of the risk practice. I also want to add that it is important for stablecoins. We're going to live in a world where a lot of banks and even enterprises think about large e-commerce platforms, the Amazons, the Walmarts of the world, will be issuing their own version of a stablecoin. So we need to be in a position to say there is a risk score on those assets, depending on many critical factors. A dollar is a dollar, but at the end of the day, it might not be a dollar for everyone. If you collateralize that dollar, some financial institutions might say this is 99.9 cents or 99.5 cents, depending on their view on the risk of that asset. So I think in that kind of world, and when you extend that to tokenized equities, tokenized money market funds, you think about cryptocurrency itself, you need to have a view of what that asset risk is at the end of the day. And you're going to need it for haircuts, for collateralization. You will need it for approving or disapproving things that you feel comfortable from a banking perspective.
So that makes a lot of sense, and clearly we can keep on diving into more detail around the ideas around integrated composability risk and how to enable risk calculations in this space, how to make it tractable, how to make it attributable, and so on. But clearly, what we can see now is time is now. The markets are well defined. The regulations, as Nikos pointed out, has set the stage. The data is available, and it's central and key that one thinks about the risk in ways that are simple, decomposable, and explainable.
I think also, Sid, in terms of the timing, I think we lived in a world when we talked about why the time is now. We lived over 15 years in a world where consumers became somewhat comfortable taking that risk on themselves. So now I think there is a pull towards the financial institutions for them to provide the same things that consumers could have access through crypto exchanges and other third parties in a way that ensures the safe and soundness and protects the consumer. So I think the discussion on risk is even more critical today, so that we can enable the same benefits, but at the same time managing the risk.
It's essentially, as you as you said, time to formalize the game, and and set whether fundamentally time to formalize the game. With that, thank you. This was thank you.
Thanks so much. It's been a pleasure.